The separation between what you can hold and what you can trade just became structural. In the next few minutes, I'll show you three things: what changed in the silver market's delivery architecture, why that change rewires the incentive structure for every participant from bullion banks to retail holders, and what it forces next across monetary metals, commodity derivatives, and physical settlement windows. The public story focuses on price volatility, premiums widening at retail dealers, and another wave of stacking content from the usual voices. That's the surface. The private move is happening in the settlement layer, where the London Bullion Market Association revised its good delivery protocols and the COMEX updated margin requirements for physical delivery contracts in the same 72-hour window. Those two moves were not coordinated by press release, but they were sequenced. That detail changes the interpretation. The lever here is called the exchange for physical spread, and it measures the gap between the paper contract price and the cost to pull actual metal out of the vault system. When that spread widens beyond a threshold, it signals that the paper market is trading liquidity while the physical market is trading scarcity. The threshold got breached. It breached quietly, without a headline, and it stayed breached for 11 consecutive trading sessions. That's not a spike. That's a regime shift. First, the LBMA announced a temporary expansion of acceptable refiner hallmarks, allowing 4 additional Asian refineries into the London good delivery system. That was framed as a supply chain accommodation. Then, within 48 hours, COMEX increased initial margin requirements on the 100-ounce silver contract by 18%. That was framed as a risk management recalibration. Then the Shanghai Gold Exchange reported a drawdown in registered silver inventory of 22% over 2 weeks, the steepest decline in 14 months. That was reported as routine fluctuation. But that's not the real pressure point. The pressure point is that all 3 moves tighten the same bolt. They raise the cost and complexity of converting paper exposure into physical possession. When margin requirements go up, fewer traders can afford to hold contracts into delivery. When good delivery standards expand, it signals that existing vault inventory is not sufficient to meet spot demand without diversifying the intake pipeline. When Shanghai draws down that fast, it confirms that physical demand in the world's largest consumer market is pulling metal out of the international flow at a rate that stresses the redistribution system. These are not isolated data points. They are sequential responses to the same underlying condition. The paper market priced silver as if supply is elastic, but the physical market is behaving as if supply is bounded. Here's where the incentives show up. Who benefits? Entities that already hold allocated physical metal in Tier 1 vault networks because their asset is now trading at a structural premium to synthetic exposure. Refineries and mints because their production capacity is being bid up as the conversion bottleneck tightens. Sovereign and institutional buyers who can meet delivery scale because they can bypass the retail premium layer and access wholesale settlement at a discount to street price. Who gets boxed in? Retail buyers relying on dealer networks because those dealers are now paying higher premiums to restock, and that gets passed forward with margin expansion. Pension funds and ETFs that hold unallocated or paper-backed silver positions because their NAV is tied to spot price, but their redemption capacity is tied to physical availability, and those two variables are decoupling. Short-side participants in the futures market because the cost to roll contracts just increased and the risk of delivery notice is no longer negligible. What gets hidden? The velocity of vault transfers, the identity of buyers taking large delivery, the reclassification of eligible inventory into registered inventory, which determines what metal is actually available for contract settlement versus what metal is simply stored in the system. When that reclassification slows, it signals that vault operators are reluctant to reclassify metal because they expect demand to increase or because the metal is being held on behalf of clients who are not offering it back into the flow. That reluctance is not published. It shows up as a lag between open interest and registered inventory changes, and that lag has widened. If the spread stays wide for another 60 days, then the paper market loses its role as the primary price discovery mechanism, and the physical market begins setting the clearing price in isolation. If vault inventory reclassification continues to stall, then COMEX registered silver drops below the psychological threshold of 30,000 contracts worth of deliverable metal, and that triggers a credibility test for the entire futures complex. If sovereign buyers accelerate physical accumulation at current rates, then the London, New York, Zurich vault circuit fragments into regional pools where metal stops moving freely between zones, and that destroys the fungibility assumption that the entire derivatives market is built on. These are not theoretical escalations. They are mechanical outcomes already being priced into the physical premium structure. The forward curve in the physical market is now trading in backwardation at the retail layer, meaning near-term delivery costs more than deferred delivery, which is the signature of a market that expects supply to get tighter, not looser. That expectation is not based on mine supply forecasts or industrial demand models. It is based on observed behavior in the settlement system. When participants see vault draws accelerate, margin requirements rise, and good delivery standards expand all in the same window. They interpret that as confirmation that the paper market's liquidity is no longer backed by proportional physical liquidity. That interpretation changes positioning. If you hold cash, understand that the purchasing power of that cash relative to monetary metals is now being determined by two separate markets that are no longer trading in alignment. And the market you have access to as a retail participant is the one trading at the premium. If you hold risk assets, recognize that the correlation between paper silver price and equity volatility just broke, because paper silver is now tracking liquidity conditions while physical silver is tracking scarcity conditions, and those two drivers are not moving together. If you rely on a paycheck, track the premium spread as a real-time indicator of monetary stress, because when the gap between paper and physical widens, it signals that confidence in synthetic claim structures is eroding and that erosion starts in commodity markets before it shows up in currency markets. The premium is not noise. It is a leading indicator. Don't chase physical silver at current retail premiums without confirming your dealer's restock schedule and premium stability over the next 90 days, because premiums that spike fast can reverse fast if vault flows normalize. Track the COMEX registered inventory weekly, because that number tells you whether the futures market has the metal to support its open interest, and when that ratio drops below coverage thresholds, the pressure to settle in cash instead of metal increases. Assume the paper price lags physical reality by a minimum of 3 to 6 weeks, because paper markets trade sentiment and momentum while physical markets trade execution and delivery, and sentiment adjusts faster than logistics. Treat the premium spread as the signal, not the headline price, because the headline price reflects what traders think silver is worth, while the premium spread reflects what buyers are willing to pay to actually hold it. And that second number is the one that determines whether the market is functioning or fracturing. Keep optionality by maintaining exposure to both paper liquidity and physical possession, because if the split widens further, liquidity becomes worthless without delivery capacity, and delivery capacity becomes illiquid without a functioning exit market. The structure of the market is now bifurcated. That bifurcation is not temporary. It is the result of a decade of underinvestment in refining capacity, vault infrastructure, and delivery logistics, combined with a surge in demand from buyers who no longer trust synthetic exposure. The paper market was designed to provide leverage and liquidity. It delivered both. But it was never designed to provide delivery at scale. The assumption was that most contracts would be rolled or closed, not delivered. That assumption held for years. It is not holding now. Delivery notices are rising, registered inventory is falling, vault operators are tightening access, refineries are running at capacity. Mints are quoting lead times in weeks, not days. These are not temporary bottlenecks. They are symptoms of a system that was optimized for paper flow, not physical flow, and the market is now demanding physical flow at a rate the system was not built to handle. The response has been predictable. Raise margins, expand standards, slow reclassification, and let the premium do the work of rationing demand. That response buys time. It does not solve the structural imbalance. The imbalance persists because the incentive to hold paper is liquidity, but the incentive to hold physical is possession, and those two incentives are no longer satisfied by the same product. When a market splits along those lines, it does not converge back naturally. It either fragments completely with separate pricing regimes for paper and physical, or it reprices violently, with the paper market capitulating to the physical market's clearing level. Neither outcome is stable. Both are disruptive. The question that is not being asked in public is whether the split is intentional. Not intentional in the sense of a conspiracy, but intentional in the sense of a policy choice made by the entities that operate the settlement infrastructure. When margin requirements rise and good delivery standards expand in the same week, that is not coincidence. It is coordination. The coordination does not require a meeting. It requires a shared understanding that the paper market's credibility depends on the appearance of physical backing, and that appearance can only be maintained if the cost of testing that backing is raised high enough to discourage testing. The margin increase tests the financial capacity of delivery takers. The good delivery expansion tests the availability of metal outside the traditional vault network. Both tests serve the same function. They slow the rate at which paper contracts convert into physical claims. That slowdown is necessary because the ratio of paper claims to physical metal has reached a level where simultaneous conversion is impossible. The system was built on the assumption that conversion would remain rare. It is no longer rare. The actors driving conversion are not speculators. They are institutions, family offices, and sovereign entities that have decided synthetic exposure is no longer adequate for their risk profile. That decision is not reversible through price action. It is a structural preference shift. When a buyer decides they want possession, not exposure, lowering the price does not change that preference. It accelerates it. That is the dynamic the paper market is now facing. Every price dip that would normally attract paper buyers is instead attracting physical buyers, and physical buyers remove metal from the system instead of adding liquidity to it. The feedback loop is deflationary for inventory and inflationary for premiums. The paper market has no tool to address that feedback loop except to make physical delivery more expensive, more complex, and more time-consuming. That is exactly what the margin increase and the good delivery expansion accomplish. They do not stop the split. They manage the speed of the split. The speed matters because if the split happens too fast, the paper market loses legitimacy overnight, and the entire commodity futures complex comes under scrutiny. If the split happens slowly, it can be attributed to market dynamics, supply chain issues, and temporary dislocations, and the system can adjust without a credibility crisis. The split is being managed. It is being managed through incremental changes to settlement rules, margin requirements, vault access protocols, and delivery timelines. Each change is small enough to avoid triggering a panic, but large enough to alter behavior. The cumulative effect is a market that looks the same on the surface, but functions differently underneath. The paper market still provides price discovery. It still provides liquidity, but it no longer provides reliable conversion into physical metal at the published price. That conversion now happens at the published price plus a premium, and that premium is not fixed. It floats based on vault availability, dealer inventory, refinery capacity, and delivery timelines. The premium is the market's way of saying that the paper price is the price of the contract, not the price of the metal. The price of the metal is the paper price plus whatever it costs to pull the metal out of the system and into your possession. That cost is now variable and it is rising. The rise is not linear, it is episodic. When vault draws accelerate, premiums spike. When vault flows normalize, premiums compress. But the baseline premium, the floor below which premiums do not fall, even when supply is stable, has been rising steadily for 18 months. That baseline reflects the structural cost of conversion in a system where conversion is no longer frictionless. The friction is intentional. It is the result of decisions made by the operators of the settlement system to slow the pace at which paper converts into physical, and those decisions are being made because the alternative is a delivery default. A delivery default happens when a contract holder demands delivery and the clearinghouse cannot source the metal to satisfy the claim. That outcome would destroy confidence in the futures market, trigger a cascade of delivery demands, and force a repricing of every paper contract to reflect the actual availability of physical metal. The margin increase and the good delivery expansion are designed to prevent that outcome by ensuring that only well-capitalized participants with genuine delivery intent can afford to take delivery, and by ensuring that the vault system has access to a wider pool of metal to satisfy those deliveries. The strategy works as long as the rate of delivery demands remains below the rate at which the system can source metal from expanded refineries, recycled inventory, and secondary markets. If delivery demands accelerate faster than the system can source metal, the strategy fails. The early warning signal for that failure is a sustained widening of the premium spread, and that signal is already active. The spread has widened. It has stayed wide. It has widened further during periods of stable paper pricing, which means the widening is not being driven by speculative demand or momentum trading. It is being driven by physical offtake. Physical offtake is the term used to describe metal leaving the vault system and entering private hands where it is not available for future delivery. When offtake exceeds inflows from mining, refining, and recycling, the system draws down inventory. When inventory falls below a critical threshold, the system loses its ability to buffer supply shocks, and every new delivery demand creates stress. That stress is now visible in the data. Registered COMEX silver inventory has declined by 34% over the past 14 months. Eligible inventory, which is metal stored in COMEX vaults but not available for delivery, has remained stable, which means metal is not being reclassified from eligible to registered at the rate needed to offset delivery offtake. That reclassification slowdown is deliberate. Vault operators and metal holders are choosing not to make their metal available for delivery because they expect future demand to be higher, or because they are being compensated to hold the metal in place by clients who want vault storage but not contract exposure. Either way, the result is the same. The pool of deliverable metal is shrinking, while the volume of open interest remains elevated. That is the definition of a fragile system. Fragility does not mean collapse is imminent. It means that the system's ability to absorb shocks has diminished, and the range of outcomes that can trigger a dislocation has expanded. A geopolitical event that disrupts refinery output, A regulatory change that forces institutional holders to shift from unallocated to allocated metal. A sovereign buyer placing a large physical order that clears out a regional vault. Any of these events, individually minor, can now trigger a cascade because the buffer is gone. The buffer was the inventory sitting in registered vaults, available for immediate delivery. That buffer has been drawn down to levels where it no longer provides meaningful protection against demand surges. The market is now operating without a safety margin. That is the condition the paper market is trying to obscure through margin increases and good delivery expansions. The obscurity works as long as most participants do not test the system by demanding delivery. The moment a significant percentage of contract holders decide to test the system, the obscurity fails and the split becomes undeniable. The unanswered question is whether the system can source enough metal from expanded refineries and secondary markets to rebuild the buffer before that test arrives. The answer is not in the data yet. The timeline is 12 to 18 months. The outcome depends on variables that are not publicly visible. How much metal is held in private vaults outside the COMEX and LBMA system? How much of that metal is willing to re-enter the market at current prices? And how much new demand enters the market from buyers who interpret the split as confirmation that physical metal is the only exposure worth holding? If the buffer is rebuilt, the split narrows and the system stabilizes. If the buffer is not rebuilt, the split widens until the paper market is forced to reprice or the physical market is forced to ration. One of those outcomes is locked in. The market snapped. It is not broken yet.